So this is going to be a short lesson on position sizing. I speak to a lot of traders on the phone, on WhatsApp, and I realize that a lot of people do not have this concept clear in their mind. They do not understand position size, position risk, and portfolio risk. These are the three terms that I want to introduce to you today properly. And I also want to give you guideline as to what position size should you use and in what market conditions. So market conditions, if you are trading in India, you can determine market conditions with the help of this link. So there are four market conditions: confirmed uptrend, in which you are allowed to buy fundamentally strong stocks which may or may not be technically strong. In uptrend under pressure, you are allowed to buy stocks which are only technically and fundamentally strong. Both conditions should be satisfied. In a rally attempt, you can buy stocks that are fundamentally and technically strong. However, you should control your position size and you should have a tight stop loss because the market has not yet confirmed that it is going to start another rally. And downtrend is outright, you have to come in cash, you cannot initiate new positions. So try to keep 50 to 75% of your portfolio in cash when the market is in this downtrend situation. So these are four market conditions. If you are trading in India, you are very lucky that you get these already from MarketSmith, and this is available for free. You don't need any MarketSmith subscription. If you are in the US, then you need to learn from William O'Neill's book, How to Make Money in Stocks, how to determine these market conditions by looking at general market indices. So there is a chapter on market conditions specifically in William O'Neill's book, How to Make Money in Stocks. So once you understand the market condition, what it is in, then you come to position sizing, because when you do stock selection, you are doing comparative analysis, technical analysis, and fundamental analysis. After that, you look at market conditions and then you determine what should be your position size. Now, in this video, I will explain to you a particular position size which you can apply in any market condition except for downtrend. Okay. So 6.25% position size is something which you can use in any of these three. Okay. However, in rally attempt, you have to be extra careful. Your stop loss needs to be tight. But 6.25 is something which I have found as the ideal position size. It is neither too low nor is it too large. Okay, so it's an optimum position size. Plus, if you read Mark Minervini's second book, Think and Trade Like a Champion, in that book also, he speaks about 6.25% position size. And then when you buy at the subsequent base, you can add another 6.25, that is 12.5% total position size in a single stock when you buy two purchases, when you do pyramiding in a stock. So it is not that he recommends 6.25. It is that he says a normal position is 25%. 6.25% is one quarter of a full position. Okay. That is what I have understood from his book. But 6.25 is a good position to start with. If you are a total beginner, okay, total beginner means you are just starting to learn, 5% position size is normal. And as your experience grows, your position size should also grow. Okay. So, what is position size? Position size equal to, I say, 6.25%. What is position size? It is the percentage of your portfolio which you choose to invest in a particular stock. So let's say you have a $100,000 portfolio. So out of that $100,000, you will choose to invest $6,250 in a particular stock. Or if you are in India, you have, let's say, 1 lakh rupees portfolio, 100,000. Again, you will choose to invest 6,250 rupees in a particular stock. In that much amount, whatever shares you can get, you have to buy those shares. Okay, the total amount of investment should not exceed 6250 per lakh at a 6.25% position size. So position size represents the amount of the proportion of your portfolio that you choose to put in a stock. So you can directly see position size is directly related to risk. Imagine putting 50% of your portfolio in one stock. Okay, that's a 50% position size. That is huge risk. Okay, please understand that. So this position size is neither too high nor it is too low. If you keep a very low position size like a 1% position size, then even if your stock doubles, you only make 1%, right? If you do the calculation. So position size should neither be small nor should it be too large. So this I think is optimum. You go ahead with this if you have little bit of experience, 1 or 2 years. If you have zero experience, go with 5% position size. Now you have identified a buy point on the chart. You have decided that you will take 6.25% position size. What about stop loss? So position risk is nothing but your stop loss, which is equal to 8%. This is ideal. 8% means you are giving enough room for the stock to fluctuate. You are giving enough time for the stock to fluctuate, because sometimes the stock will squat from its buy point. Just to give you an example, if you go here, let's go to Dixon, a stock that I have bought. Let me show you where I bought the stock. So let's go to Dixon. See, have a look at this. This arrow mark, I have bought the stock here. So on that yellow line, that was my buy point. Okay. So see, the stock closed below the yellow line after I bought. So on that day, I was at a loss. Okay. So you have to, I have taken 6.25% position size. My red line, which is my 8% stop loss, is below the green line. See, there is a green line here between the two yellow lines. You see a small green line. That is my average purchase price. So my 8% stop loss is below that, 8% below the green line. Okay. So I'm giving enough room and enough time for the stock to fluctuate. Okay. Now that the stock has gone up, I don't have to worry too much about the stop loss getting hit. Well, anything can happen in the market. My stop loss could get hit in 2 3 days, but the chances are low. The stock is showing very bullish technical pattern. Okay. Now, so that is stop loss. That is called as position risk. What is the risk that you have taken on the position? Okay, that is called position risk, position size. So what is portfolio risk? Portfolio risk is equal to position size multiplied by position risk. Understood? So portfolio risk means the amount of your portfolio which is actually at risk. See, out of $100,000, if you put $6,250 in a stock, that doesn't mean that the entire 6,250 is at risk. No, 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 because you have kept an 8% stop loss. So you are not going to lose $6,250. Okay. You are going to lose position size multiplied by position risk, which is equal to 6.25% multiplied by 8%, which is equal to 0.5%. So this is your real risk. This 0.5% is your real risk. This is the amount of money which would be $500. Okay. So out of $100,000 or 100,000 rupees, $500 or 500 rupees is something which is at risk. So, people who do not have knowledge of the stock market, they say that the stock market is risky. But they forget to ask how much risk. Can you tell me mathematically how much risk? I'm telling you mathematically your risk is 0.5%. So half a percent of your portfolio is actually at risk in spite of the fact that you have taken 6.25% position size. That's the beauty of this concept. Okay, which means let's say your portfolio is 100% cash and you see a stock like Dixon and you choose to take a 6.25% position size. You buy the stock, you keep an 8% stop loss. Okay. 99.5% of your money is not at risk. Let me repeat that. 99.5% of your money is not at risk. That is cash which you can assume that is the cash that you have with you, because your total risk as a proportion of your portfolio is only 0.5%. Very, very important point to understand from a psychological point of view. You are not risking $6,250. You are risking only $500. Okay, so imagine taking 10 trades like this. So, assuming all 10 trades go and hit your stop loss, okay, you will not lose more than 5% of your portfolio. 95% of your portfolio will still be in cash. Correct? So, my point is you have to understand what is position size, position risk, portfolio risk. Don't risk too much of your portfolio on a single stock, especially if you are learning, just learning. Okay. So if this is 5% and this is 8%, your portfolio risk becomes 5% multiplied by 8%, that is 0.4%. So 99.6% is still in cash. I mean, that's not at risk. Okay. That is why it is very important to understand these three terminologies: position size, position risk, portfolio risk. Position risk is nothing but your stop loss. Now, this is theoretical risk, 0.5%, because between your buy point and your 8% stop loss, you are going to have mental stop loss levels. For example, you see Dixon, you see this blue line represents point number 4 in the base. That's my mental stop loss. So in case if the stock begins to fall from here, so in case if the stock begins to fall from here, if it starts to close below this blue line on a 15-minute chart on high volume, I am going to start reducing my position size. And if I reduce my position size, my total booked loss will never be 8%. It will always be less than 8%, because 8% is on 6.25% position size. But what if I reduce my position size? Then my risk also goes down, right? My overall risk goes down. Moreover, you see there is one window here. There is a rising window here. So this is my second mental stop loss. There is another rising window. That means there is another mental stop loss. So when the stock begins to break down, let's say it starts to completely collapse from here, I will sell some portion of my portfolio here. Actually, I will end up making money there. Then if it breaches this blue line, I will sell more of my portion. Maybe I will sell 30% here. I will sell another 30% here. I will sell another 30% here. So by the time the stock comes to my red line, I'm only 10% position size in the stock. So even if it hits my stop loss, I have booked 8% loss on a 10% portion of my position size. So 10% of 6.25%. Okay. So my overall loss on the trade is going to be somewhere in the range of 3 to 5%. It cannot be 8% because I'm reducing my position size, right? In some cases, the loss could only be 1 or 3%, 1 to 3%. And in some cases, you might not actually book a loss, you might actually come out at a profit, because if this stock, if I sell here, okay, I'm going to book a profit, right? So your 8% is nothing but your emergency stop loss. You as a professional trader are not never going to allow your stock to hit your 8% stop loss. The 8% is for emergency purpose. If there is some war breaks out overnight and all stocks collapse, then 8% is the maximum that you can tolerate. But as a professional trader, you have these pointers between your price, average buy price, and the actual stop loss. You have certain pointers which indicate that the stock is showing weakness, so that it allows you to cut your position size. Moreover, if you look at these short term moving averages, okay, so this is 8-day exponential, which is the orange line. 8-day exponential, 21-day exponential. If the stock begins to break these two lines on a lower time frame chart, I might want to cut my position size there also, right? Because the stock is showing weakness. So if you see, if you are a good trade manager, if you are a good risk manager, your net loss on the position will never be 8%. On an average, on 10 trades, I am saying that your loss could be somewhere in the range of 3 to 5%, or maybe even lesser than that if you mark these levels on the chart. Because on some stocks, you might actually come out at a profit, not a loss. Okay. So 3 to 5% average loss per trade taken multiplied by 6.25% position size. So your overall portfolio risk is not 0.5%, it is less than 0.5%. Okay. So you are not even risking half a percent of your overall portfolio. So imagine how low risk strategy this is. That is why I say 6.25% gives you enough exposure to the stock while keeping your risk extremely low. Like half a percent of your portfolio is nothing. You can easily take the trade, right? Even for a beginner, I would say 6.25% is fine. I personally have taken 6.25% here. Then another stock, this has also gone up nicely. I have personally taken 6.25% here, but I cut down my position size because this was a squat and I had violated one or two trading rules here. Then you have time technoplast. Here I have a 6.25% position. Here, this was an 8% candle. So that green line. So 6.25% is something that I am comfortable with. Moreover, if the stock continues to go up, builds another base, and you add another 6.25%, now you have 6.25 plus 6.25, that is 12.5% position in a single stock because you made two purchases. And it is not going to be 12.5, it is going to be slightly higher than 12.5 because the first 6.25% position is already in a profit. So if you see overall your portfolio, that particular stock could represent maybe 15% of your overall uh, portfolio, including the profits that you made on that first position. So 12.5 to 15% is a decent position size in a particular stock, right? So you can build your position gradually without taking risk. Okay. So our goal is to acquire as many shares as we can by keeping the risk low. Okay. We cannot expose our portfolio to too much risk. Imagine taking 25% position size on a stock. So if this is 25 and this is 8% and your stop loss gets hit, that's a 2% loss. You have lost 2% of your portfolio. That's huge. Like, I mean, for at least for me mentally, losing 2% of my portfolio in a single stock is too much risk. In that much risk, I can buy four stocks, that too four high quality, comparatively, technically, fundamentally strong stocks. What's the probability that all four will hit my stop loss? It's very low. Moreover, what's the probability that I will allow all the stocks to hit 8% stop loss? Very, very low. So you see, that is why these terms are very important. You need to understand what I mean when I say position size. You need to understand what I mean when I say position risk or stop loss. You need to understand what I mean when I say portfolio risk. For me, it's the portfolio risk that matters. Okay. Now, this formula is a magical formula. Let's say you buy 12.5%, you keep a high position size, and you make this 4%. Now tell me what's your, so you have reduced your stop loss by half and you're increased by your position size by twice. So 6.25 multiplied by 2 and 8% divided by 2, your net effect is going to be 0.5%. So by keeping the risk same, you have doubled your position size. So keeping your portfolio risk same, you have doubled your position size. You can do that if you are comfortable with 4%. But what's the disadvantage of 4% stop loss? Well, then you are not giving room to the stock, right? You are keeping a very tight stop loss. Although you are taking a big position, there is a good chance that if the stock is volatile, if the stock is in a late stage base and it turns volatile, it might hit your 4%. So you might end up actually booking this loss. Whereas if you keep it 8%, you are giving comfortable room and time for the stock to fluctuate, like I'm doing in Polymedicure right now. So if you see Polymedicure, okay, so I bought the stock here. Okay, on this candle, it has started to come down. My 8% stop loss is here. It is very close to my stop loss, but not yet hit. The 21-day exponential moving average, which is the purple line, is acting as a support. If it hits my stop loss, my loss is not going to be 8%. My loss is going to be 4% because while buying itself, I bought a half position size. So you understand, you can play with the position size and position risk to adjust your portfolio risk. Let me repeat that. You can play with the position size and position risk to adjust your overall portfolio risk. So it's the portfolio risk that matters a lot. And in my view, in any market condition except for the downtrend, okay, a downtrend, you're not allowed to buy stocks. Don't buy stocks in a downtrend, confirmed downtrend. But for other three conditions, you could choose to take 6.25% position size with an 8% stop loss. Only thing is that for relatively weaker market condition like a rally attempt or uptrend under pressure, be tight with your stop loss. So which means in tough market conditions, this should be less than 8%. It should be kept tight. Okay. In loose market conditions, 8% is fine. Let the stock fluctuate. But since the stock in a confirmed uptrend, it may fluctuate, but eventually there is a good probability that it will go up. So in a confirmed uptrend, keep this at 8%. Don't worry too much about the stop loss or the position risk. But in a choppy market, okay, you should keep this level small or at least keep your mental stop loss less than 8%. You could keep an 8% hard stop loss, but keep your mental stop loss close to 3-4%. So if it starts to breach that level, like I did in Dixon, you could choose to manually exit the stock or reduce your position size. I have always said that your portfolio risk can only be managed in two ways. One is start reducing your position size. If the stock does not do what you expect it to do, start reducing your position size. Number two, start moving your stop loss. These are the only two ways to manage your overall portfolio risk. Position size adjustment, stop loss adjustment. You will move your stop loss up without changing the position size to control your portfolio risk. So the formula is very simple. So next time someone tells you the stock market is risky, ask them how much risk are you talking about. Okay, you could choose to invest 12% of your portfolio in a stock and still risk only 0.5% of your overall portfolio on that same stock by keeping your stop loss at 4%. Okay. Now, one important point here, sometimes stocks have a tendency to gap down. Imagine your stop loss is 4% and the stock suddenly gaps down without touching your stop loss. In that case, your loss is going to be bigger than 0.5%. But those are rare cases. Okay. Normally, a strong stage two uptrending stock, which is comparatively, technically, and fundamentally strong, generally these kind of stocks don't gap down. And even if they gap down, they try to recover. Okay. Like what happened in Zomato recently. You can check the video that I made on Monday. Why did I sell Zomato? It gapped down, but it did not lead to loss. It actually led to a gain, but you can check that video later. But you understand what I'm saying? Add this to your financial vocabulary, add this to your trading vocabulary: position size, position risk, portfolio risk. In a confirmed uptrend, you could choose to increase your position size. In a weak market like uptrend under pressure or rally attempt, you could choose to keep your position size small, okay, to control your risk. Don't play around too much with your stop loss. I like to play with position size. I don't like to play with stop loss. By the way, one more note before I close the video. Position size depends on multiple factors. Okay, number one, comparative analysis. Number two, technical analysis. Number three, fundamental analysis. Number four, market conditions. These are the four factors on which you will decide your position size. Number five, what is your personal situation? So, a guy at age 25 will have a different position size compared to a guy which is 55 years old or 75 years old. That's personal situation. Another example of a personal situation is, let's say you are having a bad day at the office or you had a fight with your spouse. On that day, please don't take high position size. Okay, that's personal situation. Next, personal position size is also dependent on your risk appetite. So if you are an adventurous person, if you like to do skydiving and things like that, you could choose to take high position size. But if you are a conservative person, like I am, okay, I like to read books. I'm a laid back, relaxed, calm, and peaceful person. For me, high position size is not recommended because mentally I don't want to take that risk. Okay, I am not a greedy person. Okay, so I'm a peaceful person. I want to do stress free trading. In such cases, those people should take small position size. So, your personal situation, your personal risk appetite, and number three, your realized gain. So, in the last 4 or 5 trades, if you have a good realized gain, then on your sixth trade, you should take a higher position size provided the market conditions are good. However, if in the previous 4 or 5 trades you have actually booked a loss or you are actually at break even on those 4 or 5 trades, then can you take a bigger position size on your sixth trade? No, because I mean, first make some money and then increase your position size, right? People get excited and they learn the system, and I want to put 15-20% of my portfolio in a single stock. Okay, I do not have a prayer for you if you do those kind of things. Okay, please control your position size. So, just to repeat, your position size depends on 7 factors, primarily 7 factors: comparative analysis, technical analysis, fundamental analysis, market conditions, personal situation, personal risk appetite, and realized gain. There could be other factors like you are going through a divorce or something like that. In that case, forget about position size. Okay, don't trade till you are out of that mental state where you are not able to think objectively. Okay, so please don't do all of those things. Position size is very critical. This is where people lose a lot of money. So it's very important that you learn about proper position sizing. And I think 6.25 is a good place to start if you have an experience of 2 to 3 years in the market. Anything less than 2 years of experience, you start with 5% position size. Minimum position size should be 5%, maximum should be 25%. The more experienced you are, the bigger the position size you can take. Thank you so much for your time. Have a fantastic day today.